All right, guys, it's Eric here again with Traveling Trading. Back at it with another video for you guys. So this one here is going to be on level 2 for beginners, and it's going to be a pretty good deep dive into level 2 and the aspects of it for you. So if you're not familiar with level 2, this is a good video for you to start with to get familiar with it. Okay. Now, for those of you who have the course and is watching this video, I'll be covering much more depth and detail on level 2 after we wrap the beginning part up. So just kind of stay tuned for that, so you kind of look at my strategies and how I approach it, and different ways to play it and other topics on it for you guys. We're here to just touch on a few more things on that topic in the course, so hang on for that. Just because due to time, and needing to understand things before you jump into level 2 a little bit more advanced, it doesn't make sense for me to cover in the course for beginners for you guys, so I don't want to confuse you. So what we're going to do here is basically just kind of cover the basics of level 2, so you guys can get a good education on it, and be able to provide you with just like the tips of the iceberg when it comes to level 2, and touch on things that other videos aren't touching on about it that I've seen online, so you guys can know as much as you can. Okay, and this will just be a foundation for you to build up on. All right. Fair warning here, after probably knowing what you're going to know from level 2 and how the market works and stuff like that, this video could probably lead you down a rabbit hole of searching and researching, and it could potentially either make you want to quit trading altogether, or continue to trade and probably even go harder, just to kind of beat the odds. You guys know my financial background, so when it comes to the financial world, I've seen the good, bad, and ugly, and unfortunately the financial markets and stock trading, even though it's supposed to be a free market, it's no different. Okay, and you'll learn that fairly soon here enough. All right, so this video is mainly for day traders. Okay, if you're a swing trader or a value investor, you don't really need to worry about level 2. You're not going to be concerned about it, because it's more for intraday scalpers and day traders who enter and exit positions on a daily basis. Okay, so that's what we want to focus on here. All right, now before we get into this, guys, if you have time, just quickly comment below if you have any questions, like the video, share it with a friend. More people that can see this, the better, so that everyone is kind of on the same page, especially if they're interested in day trading. I'm taking a bunch of time to kind of put this for free, especially during the trading day when I could be trading and everybody else is banking on BKKT and DCFC. I had to close out my positions to come and teach you guys some more, when I could have rode that wave. But anyways, we're going to get into this here. Now understand it's going to be a lot of information, so we're going to break this up into sections, so you can kind of let it digest and be able to absorb this information. Of course, you can always come back to the video if you want, at your convenience. So that's why I'm making it for you guys. All right. So let's go ahead and jump into it. What is the objective here? This video is going to be here to teach you guys what level 2 is, show you how day traders use it, how to read level 2. We're going to talk about the pros and cons of it, and we'll discuss different ways that people profit from it, and much more. All right, and of course, you guys that are staying, that have the course, going to need to even more detail with it. All right, so that's the objective here of this video. It's for me to kind of cover this with you guys, so you can have a good foundation understanding of what level 2 is, why you need it if you're day trading, scalping, and just have another tool in your tool belt to give you that edge that you need to be a profitable trader. All right. So, what is level 2? Well, let's first talk about what's level 1. So level 1 is basically where you're able to see the bid and the ask for any security that you're looking up. The bid is basically what buyers are willing to, the price point buyers are willing to buy at the highest price point, and then sellers that are willing to sell what their lowest price point is. Where those 2 points meet is pretty much where the trade takes place, and of course the difference between it is the spread. I kind of cover all that in the last video, kind of like beginning, with day trading and how it works. I'll put a link to that video if you haven't seen it. So if you need a little bit of background on this, you can look at that video and get a good, another foundational knowledge on this and what some of the stuff means, but we'll cover a lot of it here in the video too, okay? So that's what level 1 is. It's just giving you the surface area of what, the highest buyer is willing to buy a security at, what the lowest point a seller is willing to sell a security at, and of course the difference between the two, just the spread. And this little picture right here is kind of illustrating that. Now, what is level 2? Well, level 2 you'll see here in this other video, or this other picture here, is a little bit different. Level 2 provides you with a lot of insight on the price action and can tell you typically, what might be coming up as far as buy orders and sell orders for a certain security, and which, direction a stock is more likely to head. It's also known as, market depth. Level 1 shows you the current bid and ask, and level 2 basically shows you upcoming bids and asks, orders being placed. So as you can see here, these are all the orders, on the buy side, and these are all the orders on the sell side. Okay, and that's pretty much how it breaks down by price and by value. And then depending on your broker, it'll have like market maker IDs and stuff like that. But we'll go into that here in a second. All right. So let's take a look at different layouts of level 2. Okay. Sorry, I'm getting distracted looking at the markets. So let's break down the layout of level 2 and exactly what you're going to be looking at, so you can know how to read it. So I want to show it to you in different formats, and they'll vary from broker to broker. But this is the general layout of level 2. You can see here, this is a montage window. Basically, what you'll do is when you open up your broker and you want to pull up level 2, you go into the settings, you open up a montage or a widget, depending on your broker. It'll be either a widget or a montage, and you'll have one that contains level 2 orders. Okay, you can usually just Google how to pull up level 2 and then your broker's name, and it'll show you that. Or if you're using, like DAS or some kind of direct access broker, it'll usually pull up for you. But you'll see here you have bids or buyers on the left hand side and asks or sellers on the right hand side. And like I said, the difference between the two is usually called the spread. Okay. Oh, sorry. There we go. So that's pretty much what you're looking at there. Let's take a look here. So right here you have the time of the bid. MMID is basically market maker ID. The count is the count of that shares at that price. This is the size, the volume, and then this is the bid. Okay. Pretty much what you're looking at here in the different colors, and that'll be broken down depending on your broker, is the depth of volume at that order. Okay. Now what I mean by that basically is you'll see that this count here is 1400, this count here is 2403, and the size here is 2. Usually there's zeros behind it, so this 2 here is usually 200 orders, this 6 here is usually 600 orders, and these are the market maker IDs, ARCA, blah, 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 blah. The depth level for the color coordination is built on that price. So you can see here, the yellow is 52.63, right here is 52.62, 52.61, so on and so on and so on. Okay, you got more buyers willing to buy at this price here, and then more sellers willing to sell at that price as well too. And these are the closest it comes to being matched. So market maker IDs, which is basically the ECN or electronic communications network, is pretty much how the orders are getting executed. And we'll break that down some more as well too, but understand that's what you're seeing when you're seeing things like ARCA or some type of ID next to the volume and the account that you're looking at for an order. You're looking at the market maker ID. And again, this is for day traders. It doesn't really make sense to use level 2 on a stock that isn't volatile or has low volume because they're not being actively traded. So there's not much movement happening on them. Okay. And usually when it's a lot of movement happening, it's because there's a catalyst or something out there that's causing, a lot of orders to be executed within the market for that particular security. All right. As you can see here on the next picture here with level 2 screens, kind of shows you one for LinkedIn. You'll see there's the market maker IDs. You have Edge, EdgeX, NYSE, ARCA, blah, blah, blah. Different market maker IDs. Then you have like the price levels on this column here. Then you have the order size right here. Okay. And there's also the time and sales, and we'll go into that in a second. But that's pretty much what you'll typically see in the montage. So every montage is kind of different in its own different way when it's showing or displaying level 2. And you can kind of customize those depending on your broker to however you want. All right. So again, if this all seems like it's kind of going over your head, don't worry. We'll get into it a lot more detail here in a second, and it'll start to make sense. But that's pretty much what you're seeing. Bids, asks, you're seeing market maker IDs, you're seeing the counts and size and the prices and the depth of the chart of upcoming orders. Pretty easy. All right. And then these are just some more examples of other layouts of level 2. As you can see here, like with Thinkorswim, they don't really go very deep in their level 2. I barely use Thinkorswim for level 2. It doesn't really give me the depth that I need. Then you got level 2 here with Mumu as a broker. And you can see here, this thing goes pretty deeply as far as their depth into level 2. So you can see there the market maker ID, you can see the price, you can see the volume of shares. And again, there's always zeros behind that. So, this is really 35,300 shares. That one's actually 10,000 shares at those prices. So that's kind of how that works. Here's some more layouts here. As you can see the different formats with level 2, you can notice, like I said, the color depth difference between, the prices that are there. You'll see here they have this color, blue, yellow, red, green, and it shows you here that the green is obviously the closest to being executed with the orders, especially between the price-wise. And you also see here that they have time and sales, which we'll cover here in a second. And then we look at here with Beyond, BYND, market maker ID, price level, volume of shares, pretty simple. Okay, so just kind of get used to looking or seeing it, these type of windows and charts, or not charts, windows and montages, so that you can kind of get an idea of how the layout is going to look for you when you're reading level 2, okay? And then, as I mentioned before, the time and sales tape. What time and sales tape is basically the orders being executed and actually taking place. Because just because an order is pending doesn't mean that it's going to actually take place. At any time, a buyer or seller can remove their order from the market and it don't get executed. Or, the market makers can't execute it, vice versa. But anyways, the time and sales tape is basically the orders actually being placed. So you can't really have one without the other. You want to have time and sales tape along with your level 2, so you can confirm what you're seeing in the pending orders is actually going to happen. Okay? Excuse me. And of course, not everyone knows how to use time and sales tape correctly, but once you understand how to read it, and how it can use, you'll be able to understand how it's going to be able to help you with your entry and exit points. And it's very important to kind of know that and utilize that tool, especially if you're trading. What I like about the time and sales is that it kind of gives you, a look of where prices are with a stock at important pivot levels of where areas of support can be and where areas of resistance can be. Okay. And usually you'll see like, a steady stream of trades going off when you think, it gets to that level. You should see the tape usually speeds up more quickly. And we'll go over that in a second here, like in real-time examples. You'll see the tape speed up a lot more on the time and sales tape, where there's supposed to be like levels of support and resistance because orders are getting executed, and the trade size are either getting bigger or smaller, and that's kind of like your cue and confirmation that there is level of support or resistance there, and there's a more higher probability that the price can either reverse and go the other way, or it might just bounce off of it. And that kind of fall in line with you seeing the candlesticks that you do see when you do see them. It's, when those hammers come in or those falling stars come in, That's because, there's areas of support and the resistance, and the time and level, or the time and sales tape, will show you those orders being executed to create that bounce and that change or that reversal in the stock price. Okay. And this is kind of like an example of it with the Active Trader Pro for Fidelity. You can see here it'll have the price amount, the number of shares, and the time it was executed. Even though these orders are pending, it shows you here where it was executed at. Same thing here in this montage window. Not sure what broker this is. This might be DAS. But anyways, you'll see the pending orders, but you'll see here that they're getting executed: 100, 100, 100, 100, 100. And what you're typically looking at when you're reading time and sales tapes is you're looking for large orders, or, typically like what's called iceberg orders and stuff like that. We'll get into that a little bit more detail here, but those are kind of things you want to look out for. The time and sales tape is just going to help confirm that for you, because just because it shows up here or here on the bid and the ask spread, bid and the ask windows, doesn't mean that they're going to actually be executed, because people fake those all the time. Okay. Then there's also the way of looking at it through a price action ladder. What this basically do, and you'll see this here, is actually in Thinkorswim and other broker platforms too, where basically this is showing the price movement along with the amount of shares being placed in the order flow for you. Okay, so that's pretty much what you're going to be looking at. Sorry, I keep looking at this stuff. This power out, man. These stocks are going off. But anyways, so you see here is the ask side, and there's the bid side, ask side, and the bid side. Pretty much same thing, just different format. Me personally, I don't really like price ladders just because of the fact the way they look. It's kind of crazy, and this is a sliding scale. So as the price is changing, these are moving up or moving down. The center point is moving up or moving down, and it just confuses me. It could be because I've been doing this for a while too, but some people like it. I've seen some traders who like it. To each his own. It's kind of the same way to look at, it's kind of two different ways to look at the same thing, if you want to kind of put it like that. And that's pretty much what the price action ladder is. Really good tool if you can get used to reading it that way as well. All right, so let's take a quick recap here. Basically what we talked about so far is basically what is level 1, what is level 2. We discussed the different layouts, and then we discussed the time and sales and the price ladders and how to look at those. Okay, so again, level 1 just shows you the current bid, current ask, and the spreads in between them for what the highest buyer is willing to buy it for and what the lowest the seller is willing to sell it for, and that's where they meet together to execute the orders. The layouts show you the market maker IDs. It shows you sometimes the time that the order is being placed, the amount that the order is being placed, and how many orders are there within that depth of that order being placed. And it varies from broker to broker, just kind of what columns they have in details, but in general that's the format of what you'll see when it comes to time and sales and level 2 layouts. All right, so let's take a quick break here, let that soak in, go back, look at the pictures of the different level 2 layouts, look at your own, compare it, and then we're going to jump back into this and go on to the next section. All right, guys, we are back from that little bit of a break here. So hopefully all that got, a little bit of time there for you to digest it all in and be able to soak up that knowledge. I know it might have seemed like we went a little fast over it, but overall, as we continue throughout this little process of learning about level 2, you understand the gist of it. And like I said, we're going to go through some examples, real time, and be able to just kind of review it live, so you can kind of, get the understanding of what I'm pretty much covering with you guys. Okay. Before we move on here, we'll actually just take a quick look at this little video here. It'll kind of sum up everything that we're going to touch on here in this video too, pretty quickly in a few minutes. But we're going to get in much detail of it. And this came from Investopedia. Throughout the rest of this video, I'll put like 1 or 2 more Investopedia videos in there. If you guys don't know, Investopedia is a really good source to kind of look up like financial terms and stuff like that. So it might be something worth, for you to look at in the meantime. But let's go ahead and check out this video real quick.
NASDAQ orders go through different market makers and participants, including Merrill Lynch, Morgan Stanley, and other firms. Level 2 quotes show a ranked list of the best bid and ask prices from each market participant, providing detailed insight into a stock's price action. Knowing exactly who's interested in a stock is very helpful. A Level 2 quote looks like this. This says UBS Securities is buying 5,000 shares of stock at a price of $102.50. The number of shares is multiplied by 100. The marketplace has 3 types of players. Market makers provide liquidity. They will buy and sell when no one else will. Electronic communications networks are computerized placement systems. And wholesalers execute orders on behalf of online brokers who are usually retail traders. The axe is the market maker that controls a given stock's price action and spends days studying Level 2 quotes. Trading with the axe increases the odds of a successful trade. Level 2 quotes will reveal whether retail or institutional buying is taking place and when a strong trend is nearing its end. But Level 2 tricks help market makers deceive other traders and disguise true intentions. They can hide order sizes or conceal their actions by trading through ECNs. The bottom line is Level 2 orders provide insight into a stock's action, but they can be used to mislead others. That's why the average trader should not rely on Level 2 alone.
All right, so that was a good little video there. Let's go ahead and start touching on the rest of these topics here. All right, so now that we kind of got a little inside look on Level 2, let's talk about how Level 2, comes about to create the market ecosystem full of bulls and full of bears. All right. So, in the day trading course, this is why I touch on the fact that it's very important for you to understand where exactly your place is in the market, so you can kind of find your edge. And it's kind of like playing Call of Duty. And if you know the map better than the opposing team, you're gonna know exactly where to be sniping from. You're gonna know exactly where to, go and have the best vantage point to take them out. That's pretty much what you need to treat the market as well too. You need to know the ins and outs of what you're doing so that you can have the best advantage to be the best player you can. All right. So you can kind of see here, this is kind of what the ecosystem is made up of. You have the ECNs, which is the electronic communications networks, or the routes. You have the exchanges like the New York Stock Exchange, London Stock Exchange, et cetera, et cetera. Then the order flow. The order flow makes up, how the transactions go about when it comes to, the orders that are placed. And then the players that are in the ecosystem, of course, you have, day traders, high frequency traders, retail traders, and investors. You have dealer brokers, which is like, Robinhood, Webull, or, any other platform you might use to trade. Then there's institutions like the banks and stuff like that that make trades as well too. And then there's also the market makers, the wholesalers. Basically, those are the people that execute the orders that are given to them from either the institutions or the traders. And like I said, we're gonna go into a little bit more detail, of all this here in a second. So the good thing about Level 2 is, like it was mentioned in the video, you can kind of tell what kind of buying and selling is taking place, whether it's retail or whether it's institutional, by looking at the type of market participants that are involved inside the actual trading Level 2. Large institutions will usually have a different type of market maker ID than most retail traders will. Like if you see like Goldman Sachs, for example, would be like GS. Whereas, a normal retail trader like myself or anyone else would be trading maybe through like EdgeX or Arca or something like that. Their market maker ID would be, GS. And so that's kind of something noticeable that people, would look out for. If you look at the ECN and the order size for irregularities, like, you might see institutional players come into play too. And typically they're trying to keep quiet about, what they're buying or accumulating, what's taking place. But we'll kind of go over how you can, detect a bunch of different irregularities when you're looking at Level 2. So that's no problem. So who uses the Level 2? Day traders like myself, scalpers, momentum traders like myself, daily pivot traders, and fading traders. Pretty much all of them, use Level 2 because you need to see what's going on a daily basis. Typically, swing traders won't need to use it. Investors won't really need to use it. Those are mostly the traders who are using level 2. Okay, and understand there's more retail traders and speculative investors than there are computers and institutions when it comes to small caps and low floats or like penny stocks and stuff like that. Some institutions are on certain stocks, and some of them aren't on certain stocks at all. So it's kind of an in between, but kind of knowing what type of stocks you're trading will help you know what kind of players are in it as well too. So what are these traders looking for? They're looking for typically big buyers and sellers for levels of support and resistance. Many times buyers are looking for sellers to be taken out to look for a breakout, or buyers are looking for short selling to come and blow that off the roof. So that's pretty much what you're looking at. Different key areas of level 2 action that can help spot potential entries and exits. By looking at trades that are taking place in between the bid and the ask, you can tell when a strong trend is about to end, and you can tell if it's still going or not. It's because often large orders are placed by by traders. Take small losses in order to make sure they can get out of the stock in time. So for those of you that kind of know my trading strategy and what kind of charts I look for and stuff like that, and you always wonder how do I know when to enter and when to exit a trade, is because I'm looking at level 2 and I'm watching buying and selling go either faster or slower, and then I decide to enter and exit while I'm also simultaneously looking at the chart as well. It's really a good idea to look at it because it gives you confirmation of levels of support and resistance. And this is why a lot of times many people get faked out and think that the stock is going down when it wasn't. It was just taking a little bit of a dip. You combining this with what you're looking at on the chart, and you can kind of tell that, hey, some more buying might still come in on this order or on this stock, and it's okay to kind of hold it for a second and things like that. After a while, you'll be when you're used to reading the tape and looking at level 2, you'll start to understand how that looks, and that just comes with time. So now that we know what traders and stuff like that are in place of the ecosystem, let's talk about the other side of what's also in the ecosystem as well too. We have market makers. Okay, so what are market makers? A market maker is an individual or a member of a firm or exchange that buys and sells the securities for its own account. They are important because the market makers provide liquidity, in depth within the market, and they profit from the difference, from the difference in between the bid and the ask, which is the spread. That's their profit. So that's their incentive to do that. So the more orders and stuff like that can go through, the better it is for the market makers, because that just provides them more of an incentive. So their job is to execute the orders when no one else can. All right. So market makers, have different type of markets that they're in as well too. Thin markets, they make it difficult to trade because not many traders are going to be actively trading the stock, and market makers aren't really making that market. Typically they can have a large spread or a low float, and they can really move quickly when it's a big catalyst or some news, something like that causes the stock to move quickly and draw more eyes to it. And that's the incentive for the market makers there. Okay, and then thick markets where there's a lot of traders and large floats and lots of money being moved around is really not appealing for us as day traders because it's not really fluctuating much. But those are thicker markets where orders are executed. Okay, so again, know that market makers can also hide their transactions or their actions through the ECNs. So remember how I was saying the ECN can be used. Remember, ECNs can be used by anyone. So it's really often difficult to tell whether a large ECN order is from a retailer trader or an institutional trader, because anyone can use them, and they can change their IDs if they wanted to as well. Market makers, they create that spread and they profit off of the selling back and forth of the stock. So of course, the bigger the spread is, the more money for them. But of course, if there's no liquidity, no one's trading it. There's no demand for it. So their incentive, of course, is to profit. But you kind of understand that that's their job and that's what they do. They bring the liquidity to the market to allow traders to exchange when no one else would. Pretty simple. But that seems like it's a little confusing. Let's take a look at this. All right. So we know that market makers provide liquidity to the market, right? So let's kind of break down how it all works visually so that it kind of makes a little bit more sense for you and you get a little better understanding of that part in level 2. If I haven't gone over it already, what basically ECN is just the electronic computer system that buys and sells, that the buy and sell orders for securities go through. And I say securities because, ECNs are used in Forex as well too, in other markets, not just stocks and options. It's used in other markets as well too. It's just a network that executes the orders. So the best way to kind of look at it like this, the stock market, kind of look at the stock market like an island. And I got this analogy from Ross from Warrior Trading. So, shout out to him. It was a pretty good analogy. Best way to really put it, I think. The stock market is kind of like an island, like, the London Stock Exchange, New York Stock Exchange, Hong Kong Stock Exchange, et cetera, et cetera. Pretend that's an island, right? And the ECN is the bridge to each one of those markets, to that stock exchange. Okay. Now each market maker charges a toll to use that bridge. Okay. So if you want to use this bridge, it might be a $2 toll for the NASDAQ bridge. If you want to use EDGX ECN bridge, it's going to be like $5, and then ARCA is $10, et cetera, et cetera. Okay. That's what this market maker charges for you to use that toll to execute your order. All right. And sometimes your toll might be based on the number of shares you might be passing through the market. Sometimes there's discounts and rebates, but we won't get into all that right now. But that's typically what happens there. And the market makers offer the route that connects the traders to the market, which is you, the trader here. Okay. When traders want to decide that they want to use a specific ECN for their order, that's called direct routing, and we'll get into that a little bit more in a second here. And that typically affects the speed of when your order is executed. But the ECNs basically allow the brokerages or investors, from all over the world to be able to trade without third parties involved, which is pretty cool. So the ECN, it costs to keep up that network, which is why there's charges to use the network, and of course the market makers got to get paid, which is why they have the spreads and they get paid from those. Okay. But ECNs, enables trading to happen outside of traditional trading hours. So that allows, investors to be able to react or anticipate news, pre-market and after hours, is because of those ECNs. And, adding and removing liquidity, in the market is where the broker fees and order execution fees come into place and stuff like that. Okay. You got to pay the market makers to take care of those orders. Now you're probably wondering what this is right here, with brokers, broker dealers, those are intermediaries who, are authorized to, and have the expertise to be able to buy and sell securities on behalf of you, the trader / investor. Okay. They're regulated by FINRA, and your brokers, they all have their own, different, market makers they use. For example, I use kind of like one of the most popular one that people have been talking about, ever since that whole debacle thing like that. But let's say, for example, like Robinhood, but it could also be like Webull or Moomoo. They have their market makers, which, like for Robinhood example, was for Citadel, is their market maker who executes their orders and takes it to the exchange to get it done. Okay. And usually, there's also, full service discount brokers, on that level to service clients. And, market makers are typically large banks and institutions. Like I said, this one was Citadel. If this was a market maker, it'd be Citadel. But they help to make sure there's enough volume to execute the orders so that the trading can be done seamlessly. Which is why that whole issue with Robinhood and closing the orders, because Citadel didn't have enough liquidity in the market for them to be able to execute the orders. All the apes went crazy and started buying GameStop and all that other stuff. And that's where all that. If you want to kind of put that picture together, this is kind of like a good way to kind of visualize it so you can understand it. There's no liquidity there. Your orders can't get executed. And of course, Robinhood was like, hey, halt the trading. You can't no longer buy it. You can sell it, but you can't buy it because they have no more shares left. Our market maker doesn't have any more of it. That's pretty much what they say happened anyways. We're not going to get on all that. But that's kind of the visual representation of it. A key for profitability for a market maker is to be able to play both sides with as many traders as possible. So they're incentivized to bring buyers and sellers together. They want you to get your orders executed because that's how they make money off the spreads, which is why it was questionable why they shut that down. But anyways, if they don't execute trades as market makers, they don't get paid, So they're paid on executing the orders, and they're required by law to make sure you get the best, deal when it comes to placing your order. Okay, as possible. That's just their job. So hopefully this little representation makes sense here. Is you, the trader, saying I want to buy this many shares of that. Some of you go through your broker. Some of you might do direct routing. We'll talk about that in a second. But you place the order through your broker. Your broker tells the market maker, hey, I want these orders to be completed. And then it's the market maker's job to take it along whichever route you're either paying for or is probably best suited, and trade those shares and execute them onto the island of the market, which is the stock exchange. Okay, so that's when you see those buy and sell orders coming through. All right, and this will get a little bit more detailed in a second. So you're probably wondering, why is it the market maker's best interest to give me the best deal, available for the trade that I execute? Wouldn't it make more sense for them to, get one that's going to make them more money? Well, yes, but they can't do that. Why? Because it's a law. It's called the National Best Bid and Offer, the NBBO law. Basically, kind of think of it like the PDT rule for market makers. They got to abide by it. They have no choice. They can get hit with fines and stuff like that for not doing that. But basically, they have an obligation to fill your orders at the current best bid that they can have, or the best sell. So if they don't have the best shares available, they have to send it to whatever route, or they have to send it to whatever route does. And that's why viewing the tape is very important, because you got to make sure that is actually being done. So basically, what is the national best bid offer? The NBBO is regulated. It was actually a regulation from the SEC that makes brokers have to give you the best bids. Basically, to execute your orders at the lowest ask price, and then when buying at the best or highest bid price, so that you're saving the most money as possible, or being as profitable as possible when it comes to your buying and selling. And that's governed by, I think, the MMS or something like that. So one of those. It was on one of those examples. But anyways, it's governed, it's regulated, supposedly. And for example, like let's say if you were, let's use the example that was on Investopedia. Let's say if you were, if the offer was, or the ask was for a stock at $25 and 100 shares, and that was on one stock exchange, and $24.50 for 100 shares on the same stock on another exchange, and a broker has a customer who wants to buy 150 shares of the stock, and the broker is then required to purchase all the shares available at $24.50 on behalf of the customer before purchasing the shares that are available at $25. Okay? That's basically what it breaks down to. They got to get you the cheapest one possible to fill your orders. They're required to do that. Additionally, if an order for 150 shares was sent directly to the exchange first, it's required, under most circumstances, to route the first 100 shares of the order to the exchange, where the shares are available at a cheaper price. Okay, so let's say if your order was going through on a different route, then what's best matching, whatever the best matching route is available. And you can choose, you can choose not to let them do that. You can choose to have it, sent to, which I don't think that's personally, I don't think that's smart. You're trying to save as much money as possible. But anyways, let's say if one route wasn't available, they're gonna have to match it with the next route that's available. So let's say, for example, let's see if there's one on here. I'm kind of winging this one. Let's say if you were trying to fill this order of bats at 100, right, for 27, 28, 67. Normally you want to get it filled in the BATS exchange, but the next closest one is here at 27, 30, 67. Okay? Now that's not the best one that's out there in the actual market. The best one, of course, is here in NSD. So instead of them exchanging it in there, they're going to have to route it to there and give you the best fill. That's basically what the NBBO is. Hope that makes sense. And this little chart right here is just kind of showing you the breakdown of it the same way, but kind of giving you the idea of how, the exchange must happen between, NBBO. So It's really the best way to kind of look at it. Make sure I can be okay, perfect. All right, so another thing that might take into factor is what's called PFFO or PFOF, payment for order flow. And there's other little tips and tricks that they do with that. So what payment for order flow is the compensation and benefit that a brokerage sees for directing orders to different parties to trade for trade execution. So sometimes brokers get kickbacks, for that, for saying, hey, send it to this route. Like they might split the profits with them. Let's say if the market maker is making $2 off of having orders routed there, your brokerage firm, Robinhood, or whatever, might get some kickback for sending you to that market maker who's going to send it to that route. Which is why not all brokers allow you to select the route that you want to choose. Like I think like one example, you can only use ARCA, and it might be because they're getting kickback from the market makers. Who knows? I don't know. I didn't look into it. I'm not accusing them. No, I'm just saying. That's kind of one of an example. But for that, you get free trades. You don't have to pay a commission. Whereas if you went with another broker, like you went with like Interactive Brokers or Centerpoint or something like that, then you got to pay commission on your trades. But they're going to fill you at a better route because you're paying that cost. So like for options traders, the market's dominated by market makers since each optionable stock could have like thousands of possible contracts in existence. Payment for order flow is basically, unavoidable for options transactions, and the average is like I think like less than 50 cents, something like that, per contract traded. But ironically, guess what? And I've seen this on InvestVedia too. Like payment for order flow was practiced and made by Bernie Madoff. You don't know who Bernie Madoff is? Go look him up. Clearly, I haven't been in the financial markets long enough if you don't know who Bernie Madoff is, but big con artist anyways. So that's, he pioneered that thing, practiced it. We're not gonna get into all that, but anyways, so your brokerage firm, if you want to know if your broker does payment for order flow, they're required to tell you by the SEC. You probably didn't notice it when you signed up. It was probably like in the fine print. All of us, we're not going to look at all the fine print. We're not lawyers. We're just going to click that I accept agreed terms and conditions, and we want to just go ahead and trade, right? But somewhere in there probably is fine print that says, hey, we got payment for order flow. We're going to send your stuff to this when you place your order, and we're going to get paid. And you ain't even read all that. It's kind of what happens. But they're also supposed to do this, I think, like on an annual basis as well too, letting you know that they get paid for order flow. But anyways, the firm got to disclose it if they participate upon it, and you can actually request, for them to tell you that in every order when it receives a payment. So it's up to you and your broker. But you as a customer too can also request for payment data from the brokerage firms on like specific transactions if you want. I think this process usually takes like a couple of weeks, but you can definitely ask for it. You're right as a consumer with them. So let's take a look at this video real quick on ECNs.
An electronic communications network, or ECN, electronically connects buyers and sellers so that they can directly trade stocks, currencies, and other financial instruments with one another. The main benefit of an ECN is that it eliminates the need for a third party, such as an investment bank, to facilitate trades. The rise of ECNs have helped investors participate in after-hours and foreign currency trading, and ECNs have made it easy for people living in different hemispheres to trade with one another. ECNs charge a fee for each transaction. They must be registered with the SEC as broker-dealers. Transactions on ECNs are automatic and immediate. Instinet was the first ECN, debuting in 1969 for use by all small brokerages and financial institutions. Other examples include the NASDAQ, SelectNet, and Bloomberg Tradebook. Rather than existing as a physical location, these ECNs are networks that accommodate trading outside of a traditional stock exchange. Some of the disadvantages of using ECNs involve problems with technology, like when a system error slows down or stops service. An ECN can require a huge financial commitment to stay updated, and in order to keep up, many poor countries rely on more developed nations to share information.
All right. So that was a good little video summary there. So now that you kind of know a little bit about the ECN network and all that good stuff, let's talk about placing the orders in smart routing versus direct routing, because this can vary from trader to trader. So smart routing basically is, and most brokers offer smart routing. Even ones that allow you to do direct routing, they still offer smart routing too. So smart routing is where the broker doesn't ask you what bridge you want to cross to get to the exchange. They do it for you. Excuse me. They choose on what to do and how to fill your order. You have no say so in it. That's what smart routing is. Ideally, they're supposed to, it's supposed to be the best. That they, when they do smart routing, it's supposed to be, easy for you as a trader, profitable for them as a firm, blah, blah, blah. Now, the only issue with that is that, and this is where like the whole Robin Hood, Citadel thing kind of came into play. Smart routing isn't always in the best interest of the trader, but it's good for the broker, okay? Because sometimes the broker won't even send your order to the market. They'll just trade it internally. And all this does is just slow down your order being executed. And again, you can choose whether or not you want your broker to do the smart routing. It's up to you, depending on your broker. Some brokers don't allow you to choose. Like if you have like Dash Trader platform, or some of the platform that allows you to do direct routing for your orders, you can choose. All right. But sometimes choosing your own order route might cause a delay due to availability on the exchange and things like that. So just kind of keep that in consideration. Because smart routing can also be done internally, and most people don't really know that. Like for example, if you have two traders in Robinhood, one wants to buy and one wants to sell at a certain price, they're not even going to take it to the exchange. They're going to trade it internally within their system. Doesn't make sense for them to send it all the way out there and pay a fee to some market maker when they can just trade it internally. Okay. So that's just kind of something to kind of keep in mind. And then if you ever wondered, like, for some reason why your order wasn't getting filled, or you set like a stop limit or anything like that and they're not getting filled, in addition to the volatility from what's happening with the market makers and the orders in that particular security, they just might not have enough orders to fill you. Like you could have set a stop loss or something like that, or a limit order, and you see the stop price just go past your limit order. That's because no one was trying to get it at that price, or there was no way for them to execute it at that price because there's no liquidity at that price for either internally or at the market maker. So you just kind of just SOL. I see that happen a lot with traders. Everyone thinks like stop losses is this great thing. Stop losses, to me personally, doesn't benefit day traders. If you're a swing trader, maybe investor, of course, but day traders, it's too much volatility, and you need volatility as a day trader in order to profit. That's your job, okay? But unfortunately, that's the two-headed, or what, two sides of a coin. I don't know. That's just like one of the catch-22s to it. There we go. You might not always have that ability to execute stop limit order. So just kind of keep that in mind. So just kind of looking at this example here, just kind of break this down. So let's say, for example, this is the difference between direct routing and smart routing. This one right here at the top is smart routing. Let's say you said, I want to buy 10 IBM calls. You place the order, it goes to Robinhood or whoever your dealer broker is, or full service broker, Fidelity, Charles Schwab, blah, blah, blah. And then that order gets sent to the market maker, who picks out which routes, it's going to get done. Now, let's say if you don't have a broker dealer, let's say you're using Dash platform, you're connecting directly to the market makers to place your order. You're bypassing that little middleman. You're not worried about smart routing, and you can cut them all out. You still want your 10 IBM calls. Your order is going to either be, you're going to say, I want it done through Amex, I might want it done through ISC, CBO, E, whatever you choose. That's pretty much how that works. And there's certain platforms that allow you direct execution with your orders. As you become more advanced of a day trader, or whatever type of trader you are, you'll probably end up switching platforms. here and now, just to kind of see which one fits best for you. So that's kind of the difference between smart routing and direct routing. Smart routing, they'll choose for you, and they'll get your order filled at the best one. Direct routing, you choose, you pick, and you pray that it gets filled and gets executed. And that's pretty much it. All right. Here's another example of smart routing. So you have the portfolio manager / investor, whoever. You want to sell 15,000 shares of stock XYZ, right? You send that order on over to your investment bank. Here's the routing logic. First, they're going to do, before they even send it to exchange, they're going to send it through dark pools, okay? And then when they see if it's not executed through dark pools or whatever they can execute through the dark pools, they're going to put it on the exchange and get it executed there, all right? So let's kind of take a look at this example. 15,000 shares you want to sell, right? They'll say, okay, we'll take that order. Let's go look and see if we can find 15,000 shares to execute, with buyers who want to buy it at whatever price you're trying to sell it at. So we're going to check the dark pools first because that's what we need to get it knocked out. So, and we'll go over dark pools here in a second. So dark pool 1 has 5,000 shares, boom, we knocked out 5,000. There's another 5,000, boom, we're at 10,000. There's another 3,000 here in this other dark pool, boom, 3,000. All right, we're all the shares in the dark pool. Still need to get rid of this stock. He still wants to sell it. Put it back on the exchange. We only got, what, 2,000 left to sell? All right, so I got 800 here in this route. With ARCA, we got 700 here with NASDAQ, and we got 500 here. The remaining 500 here with EdgeX. Go ahead and get them executed. Or you could say exchange A, B, C, whatever you want to do. And that's pretty much it. That's pretty much how the process works, okay? But again, sometimes, people skip the dealer brokers and they go straight to the market maker and get those executed through this part right here. So, and keep in mind, the market makers have to give you the best fills possible by law. It just doesn't mean that your orders are going to always go through the exchange. Sometimes they're going to get hit with the dark pools, okay? So, Eric, what the heck are you talking about? What is a dark pool? Dark pools, right? So, and this is probably where a lot of controversy comes in, and again, this is catch-22 as far as how this works out. So a dark pool, guys, a dark pool is basically a private exchange where trading of securities are not really accessible, for the investing public. Also known as like dark pools of liquidity. The name of these exchanges is in reference to the fact that it's not transparent. It's dark pools. It's hidden. Okay. They typically carry out block trading by institutional investors, who don't want their orders and what they want to do to impact the market because they have large orders and obtain different prices for their trades. Okay, because they have such big orders. All right. So dark pools, they were kind of meant to solve the problem that was there, but it also ended up causing other problems. So another reason that they have dark pools dedicated to large investors is so that they can find buyers to be able to fill those big shares of blocks that they want to get filled easily, whether it's buying or selling. They want to be able to get that executed quickly and easily without having to affect the market and run all their transactions. They're regulated. They run all their transactions through the clearinghouse. Everyone does. It's not just them. Everyone has to go through the clearinghouse. They just do it discreetly. And what happens, because it is regulated, their orders though are delayed. Until like after the market is closed, or they'll buy a stock before the market is open and pre-market. And that's why a lot of times you guys will see me in Webull profit in pre-market or after hours, because I'm getting my orders filled by the dark pool institutions. Volume appears, and you on the retail side won't see that until about 20 to 40 minutes later after the market closes. Also, you won't see like huge volume spikes, because what they do is they'll spread it out over an extended period of time, just so they're not affecting the price action too much. And they want to just still move the normal supply for supply and demand and things like that. So dark pools, they use what's called bracket controlled orders to route, like on a millisecond scale, like very, very quickly. And again, that doesn't apply to, the dark pools don't apply to every single stock out there. Big institutions and firms, stuff like that, they're typically looking at more credible stocks, not necessarily so much, definitely not like penny stocks and, stuff like that. Some of them are, but they're like, not really all that. But anyways, they're looking at like blue chip companies, stuff like that. You'll see that a lot. You'll see dark pools a lot in those, type of environments. Sometimes you'll see them in small caps here and there. You still want to look out for them. They jump in there as well too. So that's pretty much what a dark pool is. It's just hidden orders made by big investors who are trying to either buy or sell shares without affecting the market drastically because of the amount that they have. Okay, and you might think like, oh, what about politicians who make big bulk orders or insider buying transactions and stuff like that? Well, that's a little bit different. They're not firms. These are they're public figures like politicians and insiders who are buying big amounts of a company are public figures. That's definitely shady if they're doing that, which is why they need to disclose that. And again, dark pools, they do disclose it, but they're private companies, banks, they're portfolio managers, people who are managing people's accounts. They're not really subject to so much scrutiny because they're not public figures. They're not supposed to be acting in the best interest of the public. They're acting in the best interest of their clients, which you can keep private. So that's kind of that, reasoning behind that as well too. But let's kind of put all that, the dark pool stuff like that in perspective. Let's take a look at this picture. So the picture that I showed you guys a second ago, with how orders are taking place throughout the market, still kind of the same, but pretend that the dark pools are like a port that is on the island. Before your orders are going to go through and actually get on the island, you're going to go through that port and get your orders executed there. If they can't get executed there, then they'll go to the exchange and get executed. Kind of like how I showed you in that last example as well too with smart routing. So again, retail traders don't have access to the dark pool where your shares, are available. You end up paying a higher price and stuff like that. You do have dark pool routing where you can see if there's shares are available in the dark pool, but you don't have access to the actual dark pool. And what that does, the routes you take, they don't check for dark pools. Okay, the routes you take don't look for that. So only thing you really do is try to ping it if you direct route it, but that's about it. And this isn't just a liquidity issue. Dark fields get filled on the spread and by the institution and hidden orders and stuff like that. It's just a liquidity issue. It's not necessarily, anything shady, too shady going on. That's just what it is. So there are some scanners that might scan for unusual options activity, and look for dark pool orders. But also too, those programs and scanners are also delayed because even though the dark pool orders are required by FINRA to report, the data that they report sometimes is delayed. So you won't usually see it until much later, which is why time and sales is so important because you can recognize that stuff when the order's being executed on the tape. Tape is the quickest way you're going to do it. Now some places might have scanners where they're scanning tape to look out for things like that. That's possible. If you know any programs that do that, comment it below. That'd be good to look into. So that's just kind of the idea behind dark pools and why they're there and what they do. You understand how that works a little bit more easily. Okay. So a little bit more about dark pools. Here's some notes that you guys probably want to know. Dark pools are dark. They're not transparent. They're dark for a reason. You're not supposed to know what's going on there for the public. Trading, in dark pools is all about visibility, and that's why it's, called that. Whereas in a traditional stock exchange, when you see, a send order in the market, the price of it is, it shows up on the exchange in the trading book, it's all there for the public eye to see. Only the price numbers and shares you want to buy are visible. It's pretty much how it works, okay? Now understand that dark pools, they're for everyone. Originally, they were set up so that only, big institutions could buy or sell orders and, be discreet without having to make a big impact on price and movement when orders are displayed. But now, everyone can see the intentions, of a buyer and seller when they do something like that. But big orders can also, easily alert others when someone, who is desperate to buy or sell could definitely change, the price of a stock. Without showing the size, the trade, big institutions can match orders and find them and, let them get filled however they want. But that's not the case anymore. Just like any other, stock exchange, people need to trade them, need to buy them and sell them. And this is just, how they attract more and more orders. So yeah, it's not just limited. It's not just limited to big institutions. Even other traders with smaller sizes can, jump into the dark pool. It just creates more liquidity. That's really the main reason why they allowed it for everyone, because it creates more liquidity in the market, which is better for market makers as well too, to have an abundance of orders available from different market participants, not just big institutions. All right, liquidity is the issue there, so they want everyone to be able to do it. We'll look at that in a second. I thought I had a video on it. But anyways, yeah, so that's pretty much how that works. And another thing is that, dark pools are becoming more and more prevalent, so don't think that they're going away just because you don't like them. As a matter of fact, in 2020, there was like 50, I think over 50 registered with the SEC. In 2017 alone, 40% of the trades in the U.S. were from dark pools. Okay? Another thing is that, as the amount of dark pools have grown, so has high-frequency trading. If you don't know what high-frequency trading is, you can look that up. But basically, high-frequency trading is like computer algorithmic trading, where a lot of those traders were looking for those type of orders, and they would try to jump in front of them and front-run them and execute the orders before the big institutions does, leaving the institutions without the ability to execute the orders. So, as one grows, another problem grows with it. So to satisfy the demand of liquidity, some dark pools begin, letting high frequency traders into the dark pools as well too, so that more orders could be matched. That's kind of how that worked. Dark pools are typically preferred by banks and brokers, and they're more than happy to execute trades in their own dark pool as well too, like within the bank itself. Like Citadel, would execute orders within Citadel. And they'll let high-frequency traders come in if they wanted to, but they're going to execute their orders between buyers and sellers in their own dark pool. They're not going to let, they don't, they'll allow the people to come in, but they prefer to do it internally first and then send it out to the market. Okay? So that's kind of how that works. And as long as you get your, price improved overall, because of the MBBO, why not, So it's always good to be sure to ask your broker whether or not they route your orders via dark pool or not. It's always something good to ask. Just shoot it to customer service. But yeah, so dark pools, again, like I said, that allows for front running so front running is a little bit different. So front running is when, when another trader knows that you're about to either buy or sell a stock, and then that trader goes and then buys and sells that stock before you and attempts to immediately sell the stock to you at a higher price, because there's only been so many shares available. That's what market cap and shares available afloat is. So they went and bought up all the stock and said, I bought it for $1, I'm going to sell it to you for 10 if you really want it. You ain't got no choice but to buy it at 10. So if you knew that someone was coming to want to buy a bunch of those, that that'll allow you to do that. So that's why that's another thing that dark pools end up doing, which is why they exist, to help prevent stuff like that from happening. Understand that all dark pools aren't the same. One dark pool might have a limit on trade size. Some might only allow large orders to go through. Some might, they're also called like block trades. You'll look for block trades. And then some will, only allow trades to be traded within their actual pool. So, others might allow high frequency traders to trade in their pool, others might not. So other dark pools even, differentiate themselves by the way they match the trades. I mean, it's just there's different types of, dark pools out there, so understand that they're not all the same. And also dark pools, again, like I said, they are regulated with FINRA and, respective. They have a lot of different monitoring that's happening and policing to watch their actions and make sure that they're not doing shady stuff, to a certain extent, or what you might consider shady, to affect the market, to make the market as, free as possible. So that's pretty much how that works. Let me see here. And then we'll talk about iceberg orders here, and then I'll run into that video I have on dark pools in a second. So, Eric, what the heck is an iceberg order? I know what dark pools are. What is an iceberg order? Well, it's also referred to as like soaking or stacking orders or spoofing. Basically, iceberg orders are large orders to buy or sell shares that are divided into smaller different units, and they're placed by traders or investors or institutions for the purpose of hiding their full quantity to avoid messing up the market with one big large order. And a lot of times they'll hide these orders. Even people who try to get in before big buyers and big sellers to move the price, they'll hide those orders discreetly into smaller ones. That's basically what they're doing, to soak up all the small orders. And stacking is where they're placing it one after the other. Excuse me. Where it's like sometimes they'll stack orders and create like a level of support at a certain price. Like you see the price going down to 350, and you just keep seeing 350 orders coming in, and it's not budging. It's because they're creating a floor, and they have orders that are getting stacked, that are lined up. They're getting stacked and getting taken out. That's kind of how that works. So kind of look at this for example. Let's say there was one large order for 40,000 shares. An iceberg order breaks it up into several different smaller orders because all you're seeing is the tip of the iceberg. Okay, so first you'll see an order for 10,000 shares go through, then another one for 5,000 shares go through, then another one for 10,000 shares to go through, another one for 15,000 shares to go through. All those are originally the same 40,000 shares that was placed by that one large institution. They just broke it up into smaller different ones. Happens sometimes. That actually happens quite a bit. All right. All right. So that's kind of how that works. Kind of wanted to touch on high frequency trading, but for time purposes, probably won't get into all that. So kind of look like this. So held offers on the bid. Held offers on the bid or on the offer side. The market is fair, but it's divided. Okay, so on the buy side, institutions need the ability to avoid high frequency trading and front running, which would be used to drive the prices higher, before they can buy because of dark pool orders needing to get filled. But on the other side too, the SEC. And that's why the SEC, approved a request for dark pools and venues just to protect the average American's investment in like mutual funds and pension funds and, from other speculative opportunities that's going to take advantage of that. So that's kind of why, that exists. So again, it's kind of two sides of the same coin. You're not being treated unfairly, and dark pools aren't really taking advantage of, the individual trader or investing. They're just there as a, group of because there's a group of participants who want to front run and gap up stocks, at open and stuff like that, and want to manipulate the market that way. So, which one's right, which one's wrong, it's kind of hard to say, but that's why they were kind of bringing that up. So, here's a little example of how, iceberg orders can be hidden, not just by, large firms, but also by you as a trader too. If you have a huge account and you wanted to do that, this right here is showing an example. You click on where it says use displayed quantity. You can change that quantity to a different size. And it's not just market makers. There's other retail traders do this all the time and try to trick other traders who are looking at level 2 and reading that. They expect you, if you see a big, like let's say if someone was trying to get the price to move up, they might throw in a $1 million order at a certain price at 350, hoping that other traders might see, oh man, there's a $1 million order at 350. I'm gonna, try to get in front of it. And buyers are now coming in trying to get in at like 351, 352, 353, just to try to move the stock up and up and up and place a bit higher. And then it'll take away that order. And now sellers are coming in, filling it, and it's going to drop. So that's kind of how that manipulation works. And this is kind of showing you an example of how you do it within the platform. You would click on where it says use display quantity, and unit display is 100, even though you're probably doing 1,000, 2,000, 6,000, whatever it might be. Same here with interactive broker software. This is kind of showing you what display size you want to do, even though you have a different limit size or a different price you might want to put it at, and you might want to route it through a smart route. So that's just kind of how that works and can be done. So hopefully all that makes sense as far as like dark pools, what they do, how iceberg orders work, and how they flow. Let's kind of take a quick look at this video from Investopedia about dark pools.
Dark pools are private exchanges for trading large chunks of securities that are not accessible to the public. They facilitate block trading for institutional investors seeking to avoid impacting the market with their large orders. While criticized for their lack of transparency, dark pools can serve a purpose. If dark pools are not available and a large institutional investor wants to sell 1 million shares of XYZ stock, the impact will be big. Investors may see it as a sign to sell XYZ, and the price could fall. A dark pool lets the investor sell the block, and the lack of transparency works in her favor, as the price will be better than if the shares were sold on an exchange. Broker-dealers, agency brokers, and exchanges own dark pools, whose advantages include reduced market impact and lower transaction costs. But dark pools may not reflect real market prices. If a mutual fund owns 20% of company RST's stock and sells it in a dark pool, unaware investors who later buy RST will pay too much for it. RST could then collapse when the fund's big sale goes
through. That's how it's supposed to end. But anyways, that's pretty much it. Quick little recap on dark pools. All right, guys. So I know. A lot of information, right? A lot of good information, maybe a lot of daunting information. It is what it is. So let's kind of recap what we kind of touched on here. So far, we talked about who the players are in the ecosystem of the market, and how level 2 actually plays out. We know that there's retail traders, institutional traders, brokers, dealers, and market makers. Cool. We know who uses level 2 and who doesn't. We know day traders use it. We know scalpers use it. We know institutions use it. Prop firm traders, proprietary traders, they all use it. We know that because some dark pools have proprietary traders that need level 2 to profit, et cetera, et cetera. So we know who does. We know that long-term investors, value investors, swing traders, for the most part, don't really need level 2. They don't care about it. So that's cool. And then there's, what the players are looking for. What are all they looking for? They're looking for unusual activity. They're looking for large orders. They're looking for iceberg orders. They're checking out tape. They're looking at all this stuff to see the potential impact of the market that the stock is going to have with upcoming orders that are getting executed. We know that's what they're looking for, stuff like that. We also know how the orders are executed. We know that the ECNs are the way that the orders are executed. And, some ECNs might be better than others. And we know about how the market makers, execute the orders. We know about order flow. We know about smart routing. We know about direct routing. Again, whichever one you might think is better for you is better for you, okay? We know about dark pools. We know about dark pools, how they work, what takes place in them, why they're there. And then we learned about institutional ordering types, like, when they do icebergs and they do soaking, et cetera, and how they might sometimes structure their orders to, keep that from affecting the market as well, too. All right. So I know that's a lot of information. Let it sink in. Let it hit home, okay? Because this is something you're going to need on a daily basis. And this is why I say level 2 is important. And it's a lot of times when you guys are watching me trade live, I have the charts up, and I also have level 2 and time and sales tape up. I'm not looking at just one or the other. Like I think Ross said, like, you can drive with one eye, but you got 2 eyes. Why not use both of them? And this is having level 2, like he said, it's like driving with 2 eyes. Same, really good analogy. So it's not required to use level 2. It's not required to know this information, but it does help you out. And again, in this ecosystem, for you to understand where you're at in the market, you need to have an advantage. This helps you have another advantage. Whether you want to use the tool or not is up to you, but you need that type of advantage. You need some type of advantage, and the more tools you have, the better, okay? Let's take a break, let it sink in. We'll come back to this here in the next section, try to wrap this stuff up, and then we'll know a little more, all right? So let's get ready. All right, guys, we're back at it again here. So let's kind of wrap this bad boy up and call it a day, all right? So we already went over the recap of everything, which is great. Now let's kind of move on to a different subject of it, where we're talking about strategies that are based around level 2. There's pretty much, different ways to formulate strategies around level 2. You can do it for the long term, you can do it for the short term, whichever you prefer. With short-term strategies, they can typically be based on scalping, where you can grab most of the move, or even doing breakout strategies where you can, anticipate the stock being able to break out, where you're looking at it at different levels. Of course, combining that with different indicators and oscillators will help you be able to, have more of a confirmation with that. But that's what a lot of, day traders and scalpers typically are doing, okay? Long-term wise, you can, use it when you're looking at block orders or large orders from institutions that might be coming in, or public figures as well too. Looking at certain price levels. Some people, they might follow politicians and, who might looking at, certain stocks, or they might follow long-term, value investors like maybe Warren Buffett or, Kathy Woods and, all those people that, affect the market as well too. And just being able to grab, most of the moves, when they're buying at a certain point, you might, grab it at a good range. So whatever, benefits you. And of course, you guys in the course, I'm going to show you little tips and tricks on how to do those strategies in a little bit more detail. But those are just some ideas of being able to have strategies based around level 2. So you might be wondering, well, how exactly do I profit from, having level 2? Pretty simple. Like I said, you can spot potential breakouts and ride those waves up when a bunch of, orders are coming in or going out. And obviously, if you're spotting breakouts and consistently compounding your gains with the right volatile stocks at the right moments of high momentum, and fast-moving tape, you can easily anticipate, big moves or a few cents to a dollar moves, and just let that compound over and over and over. That's, a good way to profit from level 2. Another way is, being able to find entries and exit points, throughout a trade that you're in, not getting, stuck in a trade, not knowing where it's going, even though the stock is moving up and down, you're not for sure where it's going to go. Level 2 will kind of help you find those, areas of support and resistance as well. And most importantly too, you're saving some money. So that in itself is a profit, by not buying too high or selling too low. If I see out there's, a whole bunch of people trying to sell at 350, and right now the stock is trading at, 348, why would I, and I want it to go higher, why would I get in when it's, a bunch of people trying to sell at that point? I'm already at the high point. So, in that instance, you're saving yourself money, or vice versa if you want to do short. Those are, some of the key ways that you can profit from using level 2. But enough of all that talking. Let's take a look at how to do this all, all together. So what I'm going to do right here real quick is show you guys, how to set up level 2. We're going to break down, what are some things that I look for as well too. Trying to recognize like large orders, market makers, iceberg orders and things like that, and just kind of planning strategies around it. So we're going to walk through that here real quick. And this is all real time, so I can't, unfortunately, rewind it. You just have to watch the video and rewind it. So this is all going to be real time. I'm going to be missing trades for this, so, pay attention, all right? All right, guys, let's go ahead and get into it. I'm going to quickly show you how to set up the level 2 and the time of sales on your brokers that can. We'll just run through it here real quick with 3 brokers. I'll kind of show you the difference. And then once we're in like Weevil, I'll show you, what I look for on the tape, and we'll kind of go through some real-time examples. Since it's after hours, you won't really have to, worry about the speed of the tape. It won't really be moving at all since the market is closed. But this will give you a general idea of what to kind of look for. So right now I'm in Trade Up in their platform. And normally when you're in the platform, you're going to click on either like one of their widget tools or their montage, and you look for something that has to deal with the book, which will typically be either order placements, or it'll say open book, just they name it different things. So you typically want to play in your broker and see, what all the functions that are there. But usually the time and sales tape will be there somewhere within a montage. And in this case here, it's in the toolbox for trade up, and you would click on I believe it's order. I'm sorry, not order. My bad. It will be under quotations and then bid and ask. And you'll see here we have Apple. It kind of just does that by default. You can adjust this later on. So you see here, this is just basic level 1. Now trade up doesn't provide level 2. I don't know if you can subscribe to it or not here. It's still a newer broker, but as of right now, they only have level 1. So you can see the bid and the ask, and pretty much, that's all you really get with the current price and the spread once the market's open. That's all you get. So sub brokers don't even have that access. So you just want to, double check with your broker and make sure you got it. But let's take a look here. Trading, or not Trading View, but Thinkorswim, and we'll see how to put it on there. So when you open up Thinkorswim, you'll have, basically this. And then what you'd want to do is click on the side here where it says level 2. And there it'll pop up your level 2. Now you also want to add your time and sales, which will be right here on the side as well. And along with that, you typically want to have active trader that'll give you that price ladder. If you want that, you don't have to have that. Since you have your level 2 here, you have your time and sales tape here. This right here is only there if you want it for another visual. So it's not required, but just kind of showing you guys where it's at. And again, you'll see, the bids, the asks, the exchanges, the value or the amount, the quantity of the order, and that's pretty much what you get with TradingView. As you can see, it's not really in depth, so I don't really use it that much. But if you do use, I keep saying TradingView, Thinkorswim, then it's perfectly fine. That's the one you can, can use, and you can watch this price ladder move up and down, and you'll see the time and sales tape executing right here. We'll do another quick video when the market's open and just kind of go over, that again as well too. But let's take a look at using it with Webull. So obviously you log into your Webull account. This is like a blank platform. If you're logged in and you go to the customized section where you're going to do your trades. And same thing here. You click on widgets, add widgets. Now what you're going to look for, of course, is going to be time and sales, which is what you guys usually see me have. So there's a time and sales. And I've set this all up in the Webull setup for beginners for you guys as well too, so you can refer back to that if you need to. Then you're going to look for your order book. That is your level 2. Okay. And then I think that's pretty much all you need. Again, I don't want the price ladder. I mean, if you want to use the price ladder, you can, but you can, look throughout here and look for, different widgets you want to add. But those are pretty much, the 2 that I would use. Now, once you have these set, as you can see here, again, it's after hours. Obviously, this is the SPY, but if we change it to a different stock, it will look different. But you want these 2 to coordinate. So what you want to do is make sure they're matching. So you want to set them as the same group, because you want what changes on here to change that. So let's just say I want to name this group 2 and this group 2. That way, when I click on an app like Apple, the chart will change to Apple's time and sales and Apple's order book. Whereas if it was just, group 1 or just a blank group, and I said, let's look at IBM, it would just stick with IBM and that wouldn't change. So you don't want to you don't want to mess that up. So make sure those are the same. Now, you might be saying to yourself, it's not as in depth as I thought it would be. Which obviously again causes after hours. What we're going to do here real quick is look at some stocks that are moving after hours to see their time and sales tape. But what I like to do is extend this a little bit longer, because you see it'll show you all the time and sales tape throughout the day. Here you got the time, got the price, quantity it was executed. Remember to add 2 zeros there if you want, you don't have to. And then you have the exchange that was routed through, all right? And then of course, here on my level 2, by default, it only gives you a certain amount. Now here you can adjust the settings to it. So let's take a look at KBL. I believe that was moving after hours today. Oh, you want to make sure these are set as the same group so they'll both change. KBL. So yeah, selling the data available non-trade hours. Typical. But yeah, that's pretty much what you're looking at there. Obviously, there's no orders coming through, so that's easy to know. But in my order book settings, what I'd like to do as well too is have this, set up to where the details are all together. So let me put that there. And then let me pull this up here real quick. We can look at HTCR. So I think that is on the watch list tonight as well too. And again, this is the time of sale. So, normally I have my order book going down, like 30, I believe 30 is the longest you could do it. So the orders are shown all the way down to 30 deep there. As a matter of fact, you can actually pull up an example. I don't know. Well, it's after hours. We'll take a look at it once the market opens. I'll show you guys how it looks in real time. But so since HTCR was on the watch list, and again, you want to look at the time and sales tape because that tells you, a lot more detail than the actual order book of pending orders that are coming up. What I'm going to look through here for is unusual, orders going through. I want to look for a big either buy order or a big sell order. Okay. And that could be seen throughout the time and sales tape. Now here, probably the biggest order you probably see, this would probably be after hours. Not much was going on there. So probably the biggest one that kind of stands out is the one that was actually, let me pull this up here. Oh, it's just taking some time to load. Okay, so like this right here would have been something noticeable. $5, $39,000 order. If you look at the chart, let me actually pull the chart with you so you can kind of take a look at that. Come on. I forgot my computer's going to be running slow because I got all this stuff running on it. See? Oh, I was tripping. It wasn't me. Close out some of these. Alright, so we're going to sync them together. Boom. Now, for one reason or another, you may be looking at, HTCR. Again, it was on my radar because of the fact that, it IPO'd today. It's a low float, so I'm going to be looking at it to see, what it does. We got it on the 1 minute interval. And let me change the chart settings. Show extended hours if you like to look at extended hours. And of course, this isn't my chart setup. You guys know what my chart setup looks like. But we're not going to get into all that right now. But yeah, you can see after hours it made a strong move up. And that big order pretty much came through right when it broke the highs at $5, which is probably what propelled it. So you got some confirmation there. You see that, that high right there broken after hours, because throughout the rest of the day, even when it IPO'd, it had a lot of resistance, didn't really go too much of anywhere, and then just, kind of straddled along the rest of the day. But as you can see here, it broke highs after hours and, ended up at like 590 or almost 610 and went to the highs. So that could have been because of the fact that there was a bulk order here, a bulk order there. These highlighted sections that you guys are seeing, and this took me a while to kind of get from Webull the clarification on that. It's basically just different order actions that are happening. So when you see stuff like that, for example, when you see obviously the green buy orders, red is orders trading at the red is orders trading at the bid price. Green is orders trading at the ask price. If it's black and white, that's going to be orders trading between the bid and the ask, like these right here. And then when you see something that's highlighted green, that means it traded above the asking price. And if it's highlighted red, that means it traded below the bid price. So right here, like I highlighted green, highlighted red. I'm sorry, highlighted green. Not many highlighted reds, but yeah. So that's pretty much what you're looking at. Those bulk orders can indicate that, there's big buyers there, 495. And you want to look at, NASDAQ route. It was another NASDAQ. Nothing standing out as far as like any dark orders, dark pool orders that I see. But yeah, reading this takes some time. Watching the orders go through. Like I said, that's notable at $5. That's notable at $5. There's some support there at $5 in that area. So that's good to know. Obviously from there you can, trade how you wish and just kind of get an understanding of, the price action that's happening and have some confirmation of what's going on for the stock. All right, so now let's take a look at it in real time. All right, guys, so real quick here, we'll look at what's going on now with HTCR and pre-market. The market's going to open in about a few minutes here. But just kind of look through the tape here. You'll see, there were some orders getting filled around this area, and it's kind of something that's noticeable with the amount that's there. And you kind of match that up with kind of what happened with the chart here. You can see it spiked all the way up pre-market and pulled right back down. We still haven't gotten below that big buy support area, the $5. Hasn't fallen below them yet, so you can kind of tell that acts as an area of support. That's kind of like a good range to set your risk management to. But what I was showing you guys here is that I like to go my market depth as low as I can, up to 50 if you can, but obviously it's going to be, beyond the screen. But this is a good example of, how deep the market view can go for you, if you wanted to go that deep. Again, it's up to you. But yeah, just kind of looking at this tape here, you can kind of notice difference in the orders, kind of match up with what's been going on, with the market so far for HTCR. Now, right now, what we'll also look at too, because it's kind of running, is the RCC. So this might be a good example for you guys. Look at this tape here and look at the chart. See, right now it's spiking on up. You got, these orders coming through here, pretty big orders, so it's probably gonna, shoot up some more, touch the high of 1948. But as you're looking at the tape and the orders going through, it's kind of balanced right now, which is why it's where it's at. But we'll see if this thing spikes up some more. I wanted to trade this, but I know I needed to record this for you guys to kind of give you some good examples. So hopefully this is something you can appreciate. Since I'm not in this trade, I could have been making a lot more money. The alert's been going off for a minute, but it's good to kind of see this in real time. Got a big buy order here, 1720. Me personally, I probably would wait for the pullback. If I was just now looking at this, you see the volume has spiked up quite a bit so far, right before pre-market. But yeah, so this is kind of how you would get to looking at reading the tape and understanding price action of what's going on, what's up and coming, what has already happened, help you determine, entry and exit points, like, a decent size order here at 1892, and then you got, a good level of support at 1720. So you might want to trade anywhere between there, or, whatever your strategy is to fit, your trading style, however you want to do it. And of course, along with other things you're looking at as well too, helps put all that stuff together. This is just a little bit of, what you're looking at. See, as you can see, that red tape came in and started to come down some more. Now it's holding up a little bit because more green tape came in. Hold up a little bit more because more green tape is coming in. And you're not seeing nothing, too noticeably different so far with these orders. They're between, 2 to 100. There's kind of a decent sized order there. Look at that. So this is a perfect example of looking at the tape. So we'll take a look at this for a few minutes Probably by the time it opens, I'll stop recording this because I want to actually trade. But yeah, so you see as the green is coming through, the order's getting pushed up, getting pushed up, getting pushed up. More green tape is coming, more green tape is coming. It's probably going to spike on up again. I'm not looking at all my indicators just now, but as you can see, it's forming a hammer candle right here. So that's a good sign that it's going to be, spiking up as well too. Along with some other indicators might help out as you're reading the tape. You still got a good level of support right around that 1720 area. This thing hasn't pulled yet. So that's probably telling these, sellers here that, hey, more buyers are coming in. And as you can see, the candles are reflecting that. The tape is reflecting that. More buyers might be seeing that thing and that level of support and trying to get in on it as well. And look at that here. So at this point, you might be saying, no, I want to, place an order in on the ask or on the bid or however you want to do it. You're looking at forming a strategy. So we'll see if we got any noticeable orders aside from that, $35,000 size order there. And this is real time. It's not sped up or anything like that. This is, pretty much what you would be doing day in and day out. All right, so we got a decent level. Oh, that's gone. So yeah, buyers are kind of stepping up here. Looks like 1872 might be actually well. See, there you go. 1892 might actually be a little bit of a resistance there. It looks like. Might be some hidden orders. So as you can see, those orders that came through some of them were NASDAQ with a mixed TRF. So it could be, a mixture of retail buyers and sellers and institutions. So it's kind of good to keep that on, back of your mind there. So you got a few bids going through, still holding up. Let's see if we see any kind of like iceberg. I mean, it seemed like this, this 1892 is kind of hard to go through here, and orders keep coming in on it. So that's kind of something to consider. That it might be a level of resistance, and obviously sellers, will know that, buyers will know that, and they're gonna probably end up dumping, since it's not breaking past that level. But we'll see. Sorry if that was loud. I didn't realize the bell was on. I think this one. But yeah, look at that. Let's take a look at that. Wow. So you got, a lot of sell orders coming through. Resistance, a little bit of resistance at 1910, some at 20. So it still has a little bit of a room to run if these orders do get filled. So some traders might be waiting and anticipating this breakout here. You still got a little bit of support here at the $18 level, which is why you got, all that movement happening right now. And this is a pretty big spread, almost 20 to 40 cent spread it looks like. Sorry, guys, I'm trying to multitask over here. So yeah, so look at all that red coming in. And this is where short sellers might want to jump in, is probably try to ride that wave down. See how it fits them. Again, there's so many different ways to kind of play this, but you can kind of see how these buy and sell orders in a depth chart are reflecting somewhat what's coming on the tape. That's a big sell order. That's a big sell order. buyers are trying to come in. We're losing. It looks like we're losing buying support here. So, and sellers are coming in. Kind of like I said, you know, the sellers are going to come in and try to dump this thing. And this is exactly what happened. And see, remember you had your level of support at around the $17 level. Now it's starting to bounce off of that. And that's what you want to look for, is see if it's going to bounce on that or if it's going to, you know, crash through. If it crashed through, ride the wave down. If not, you know, long it. And right now it's still kind of holding at that 1780 level. So we'll come back to BRC. Let's take a look at KVL. So you guys can see this thing is shooting up. So you got levels of resistance at 260. Let's see if it breaks past that. See, every time these 260 orders are getting eaten through, they're coming right back. So that's a good sign of an iceberg order at 260. Let's see if it breaks that. See how they keep getting filled, keeps coming and coming and coming. And if you're looking at the tape, I know it's kind of fast, but you know, it's quite, look, there was quite a bit. There was a big 10,000 order that came through. 6,000, 4,000, 4,000. Yeah, so there's you know, there's a resistance there. It's kind of easy to tell right there. So I wouldn't get in at this point. I would wait for a little bit of a pullback. And you got some support here at 245. Let's see, I think that got eaten through pretty quickly. There's definitely some hidden orders coming through here. So, and I'll show you guys, you know, like I said, that are, you know, in the course of like that, how to make this a little bit more easier for you. But right now I just wanted to kind of give you some examples. So you got big orders here at 220 and big orders here at, you know, at 258 of what's being shown so far. Now you got more buyers stepping in, putting more pressure on the sellers. And then of course, you know, again, you'd strategize how you'd want. But I just wanted to give you guys another example, you know, how to read the tape and what you're looking at, sizes, bids, asked, the difference between spread. This is a, you know, relatively small spread. It's only about, what, 1 cent, which is good. This would be something I'd be interested in trading as well, too. So, I think KVL was on the watch list as well for us. But yeah, we'll see. I think that should be like enough time here for you guys. I gotta jump back in here in a second. I might actually do a little bit of trade. Oh well, look, let's take a look at this real quick here. Man, see how this is definitely an iceberg order right here. Look how it keeps getting filled as it's getting taken out. Orders are just coming through, coming through, coming through. So again, this is good to read. You know, a lot of times when you see your traders or your gurus, you know, pretend like they're just looking at chart patterns, stuff like that. They're also looking at tape, and they're looking at, you know, orders coming in and orders going out as well too, and they're playing in between them, deciding if they're going to enter or exit. You know, so it's just a combination. It's not just chart reading. It's not just pattern recognition. It's not some special indicator. This is another part of the piece of the puzzle that they're utilizing that they don't really go over a lot when it comes to trading. So hopefully this little video helped you guys out, again, an idea of what to look for and what, you know, is important, especially in day trading or scalping or whatever you might be trading during the day, if you're trading during the day. But yeah. And right now, it looks like the sellers are winning here. I mean, there's way more sell orders than there is buy orders that are going to be executed from so far what it looks like. Ideally, you know, won't put too much emphasis on it. Make sure, you know, keep an eye on it. Make sure orders aren't getting pulled. If they are, you know, trade accordingly. And just kind of pay attention to that. So it can be stressful just trying to look at this for, you know, minutes on end, throughout the day, especially when you're working in your trade. So imagine if there was a slower like movement of action when it comes to a trade. Like let's take for example CLSK. Let's see if that one's moving much. So it's not much liquidity here. This is a perfect example. You can see like the spots in the candles are like where it's being executed throughout, pre-market. There's not many eyes on this one. Not much of a catalyst going on. Of course, in the opening bell, you're going to have a lot of movement, but probably come throughout the rest of the day, you're not going to see much of anything happening. It's a 5-cent spread. The spread is small, but you don't have really many buyers and sellers, and the tape is moving very, very slow. As a day trader or a scalper, I really wouldn't be interested in this because there's not much action going on. It's not a lot of volume taking place here. Not enough for me to be able to get in and out of the trade. It's not very liquid. Little bit of price movement, but not much. So this one is kind of, easier probably for you to read the tape. You can see there's some good level of support here at $9. A little bit of decent resistance at $9.45. Looks like, based on the candlesticks here alone, that most of the sell orders are getting filled, which is, ideal for short sellers and stuff like that. So nothing too noticeable as far as any big levels of resistance. You got a decent order of buys there at 931, which is probably why it's still hanging around this area. That's gone through already, but sell orders look like they're mounting up. So this is kind of something to kind of pay attention to as far as like the differences in between trading a volatile stock and a non-volatile stock. One is more liquid than the other, much more fast moving. And as you can see, this thing looks like it's trying to form a cup and handle. But again, you want to look at leading price action. You still got resistance at 270, 260, and right now you're at 240. So you got room for a 30-cent move if you wanted to jump in right now. You can see if it gets filled, things like that. Manage your risk accordingly. Buyers are stepping in a little bit. Things are getting me halfway. So that's kind of how that works. All right. Hope that helped you guys. All right, guys. So hopefully you enjoyed that little tidbit of information there. Like I said, I'll try to go in more detail with it with other brokers if needed, but I just want to kind of give you guys an example of how it works and what to look for and all that good stuff. So let's kind of talk about the pros and cons of level 2. Obviously, everything has its pros and cons, right? So it's kind of good to know them, in general. Some of the pros, of course, with level 2 is that, it shows you more information on like true support and resistance. The charts might look good and they might show, levels of support and resistance that aren't really there. So ideally, that would mean nothing. But level 2 kind of helps you see all that in detail. It also gives you a clear idea of, market sentiment towards a particular security. So that's good to know because you don't want to, fight the trend. You'll hit it a lot of times in trading. And another pro is that, you can get quick profits. You can get in and out. A lot of scalpers use it. There's people in the chat room that are, great at scalping, and those guys will make, 8 or 9 trades within 30 minutes and profit really well. But of course, they have alerts so they know what stocks to look for. But, being a scalper and knowing where, those stocks are, that definitely, helps you out. So that's another pro for it as well. I'm not good at scalping, unfortunately. I tried it. I'm horrible at it. But yeah, to each his own, right? Some of the cons though is that, it's not foolproof. Obviously, there's a bunch of, manipulation that can go on within level 2. So it's not like, solid. So, there's that. There's fake orders that can affect your decisions psychologically. That's why, institutions or either other retail traders might put fake orders in there to kind of make you think one thing and it's actually going to be another. And there's that little, the mind game and manipulation and psychology behind it. So that's, one of the cons about it. It's not straightforward. And then another con is that it's not fully transparent. Obviously you have your dark pools and, institutional buyers and stuff like that, things that you can't see going on, but you can kind of recognize a little bit, but, it's not fully transparent. So that's one of the other cons of it. All right, so what I'm going to do here now that we kind of went over all that, I'll just go through a few questions some of you guys sent me about level 2. And, the subject, it's not really many, which is good, or or bad, because either you didn't know about it or you knew about it, just didn't know what to ask. So I'll just go over the questions that I got sent to me, and then wrap it up here with just my final thoughts for you guys. So one of the questions is, why didn't my limit order go through? I think that was kind of like a question about seeing your limit order in a level 2 exchange. But limit orders, guys, are not guaranteed. Understand that. Just because you have it set to get it at a certain price, even if the stock does touch that price, it's not a guarantee that your order will get filled, because there might not be enough shares at that price or even at that route for them to execute your order. Remember, they have to follow the NBBO, so if the stock jumps before your order, or let's say you place the order and the stock jumps above it and you can't get filled, or vice versa, that's just how it is. So limit orders aren't always guaranteed. A lot of traders, especially new traders, think that, if I set a stop loss or a limit order, it's going to get filled. It's not like that. Which is also, why paper trading can be misleading for you. It's more for testing strategies, because when you paper trade, your orders are going to automatically get filled. Doesn't matter. But in real life, your order might not get filled, or it might get partially filled. So understand that's why, because you need buyers and sellers, and if no one's getting it, if no one wants it at the price you're asking, it's not going to go through. Even if the price did touch that, there were orders ahead of yours that got filled and yours didn't. That's just how it works. Can a stock trade on multiple exchanges? Yeah, like one stock can be on multiple exchanges. Like a company can list shares on more than one exchange. It's often referred to as like dual listing, where a stock can trade on like NASDAQ and Amex at the same time. Most of these companies gotta meet like the exchange listing requirements, and they gotta pay like fees to be associated with the exchange and to be listed and traded and all that good stuff. So I mean, it's not common, but it is possible. I think Zillow is like one of them. I don't know. I gotta double check and see. But anyways, yeah, so it can be done. Can you buy on one exchange and sell on another? I'm assuming you mean like the actual exchange, not the ECN. But yeah, you can do that. You can buy shares on one exchange and sell them on another exchange. It's definitely possible. If a stock price is listed on more than one exchange, I don't think I answered that question. If a stock price is listed on more than one exchange, will that affect the stock price? Yes and no, because if they're gonna have different rates of exchange, then it really wouldn't affect it. So dual listing typically allows the company to kind of just increase access to the capital and make the stock itself more liquid. So it really shouldn't have too much effect on it. Not that I can think of, just off the back of my head. So yeah. Can you exchange? Oh, we already went over that. Buy one on another exchange and sell on another. Yeah, we already went over that. You can do that. So can retail traders access dark pools? No. Well, yes and no. So you can access dark pool trades, not like fully in real time, because they're required to have it published through FINRA. FINRA publishes dark pool transactions through like alternative trading system data on their website. I'll give the website to you guys in the course to kind of be able to look that up if you want. But yeah, you can see dark pool stuff. It's just not real time. Okay. Which is why you want to be doing, the pinging and looking out for, the trades from dark pools. Because by the time you look at it, it's already happened. It's a lagging indicator if you want to kind of look at it like that. But are dark pools required to report their transactions and trades? They certainly are. So understand with trading platforms like Dash Trader, Lightspeed, and other ones, they have real-time windows where you can see trades that are being made in dark pool. I don't think Webull has that, or like any of the discount brokers have that. And sometimes they're listed as like FADF, and those orders can't be seen on level 2. And FINRA requires them to report it. Like in the example I showed you, like where the trades were showing as TRF, that's called Trade Reporting Facility. Those trades got to be made during the hours and got to be reported immediately, whereas the other ones, don't really have to. So whenever you see trades like, TRF, it's just, could be a dark pool transaction. So you guys see that in the overall example I just showed you. But yeah, good question. So that's pretty much all the questions there. My final thoughts, guys, it's pretty simple. Don't always rely solely on level 2. You always want to use it in a combination with other indicators, isolators, to be able to, strategize and trade accordingly. So that's one thing to consider. Don't just solely rely on it, and watch out for the tricks and stuff that goes on in it. My other thoughts is, don't use market orders, don't use stop limits. You guys hear me preach all the time. Everybody asks me, Eric, do you set stop limits? Do you do limits? No, I don't, because I'm not showing the market makers my hand. That's like playing poker and saying, here's all my cards. They can see those orders. So I don't want them trying to trade against me and, puts me at a disadvantage. But mentally, I keep mental stop orders in my mind. And that's where discipline comes in as a trader. I know if the prices get to this point, I need to go ahead and get out. And it's very, very hard for many, traders to do that, especially, new traders and stuff like that. Discipline is very, very tough to do. And that is exactly why, because as traders, you don't want to be showing on your hands. But I don't use stop limits. I mean, if I'm like on the go or something like that, and a stock is going my way, and I want to let the winner win, but I got to go do something, or I'm traveling and stuff like that, and or at the airport. There's been times where you got, like a lot of times this past year where I was taking trips. I'm in the airport, I'm in the trade, and right before takeoff, I gotta go. So, and I'm still in the trade because the games are still going. At that point, I might set a stop limit. I get off the plane, and my order's taken out. It's fine. I profited. I don't care. But when I'm stationary or have time, I don't want to trade and use stop limits or anything like that to get taken out. And market orders I don't want to use, because market orders, especially momentum stocks, will get you the worst fills possible, especially if you're trying to trade them like after a halt or something like that. Market makers will eat you alive and give you the worst fills possible. Well, it's not the worst. They'll give you the best fills possible, but at the worst timing, to where it's like the worst, the worst entry. Unless like a stock was like shooting. And I mean, really what I want to use a market order if I don't got to. If you're a scalper, you might be okay with it, but I'm not personally as a momentum trader. So I do limits. And then also my thoughts is, the advantages of having level 2 outweigh the disadvantages. And it's not required to use level 2, because you can still be profitable without using level 2. It's just, another tool in your tool belt. And remember, guys, trading successfully isn't about getting it right or wrong every single time. It's not gonna happen. It's more about increasing your odds of the chances of you actually being right in your strategy and plan working out. You want the odds in your favor. Pretend like it's Hunger Games. All right, make the odds be ever in your favor. But level 2 helps give you better odds and increases your edge, and pretty much help you with trading altogether. Okay, so that's my thoughts. That's pretty much it for this level 2 video. Hopefully you guys enjoyed it and learned some new stuff. Again, that's always the goal. If you have any questions, definitely put them in the comments. If you can, do me a quick favor, like this video, subscribe to the channel. I'll be putting more stuff out like this for you guys as much as I can, and much more detail, because there isn't stuff like this out there on the internet that's as detailed as this. A lot of it's just a bunch of fluff, and a lot of people want just information. And I'm gonna try to put out that as much as I can, and keep more coming for you guys. But I do need your support. I need you to like this video, I need you to comment, share it with a friend. Hopefully they enjoy it too. And we all learn some more together. And I don't want to bog you guys down with too much information, especially if you're a new beginner, because it can be overwhelming. But for those of you that are like in the course like that, you're gonna get slammed with all this stuff. So that's what you're paying for to learn. So get ready for that. But that's it, guys. Hopefully you enjoyed this video. Like I said, if you have any questions, let me know. But until then, stay green. And you guys that are in the course, stay tuned for the rest of the stuff that we're gonna go over here with level 2 and level 3, so you can learn a little bit more. All right. All right, guys. So if you sat through that video, thank you. I appreciate your time. Hopefully I gave you some value here as far as learning a little bit more about level 2. So I hope you liked the video. If you do, like I said, please give me a thumbs up, comment below, like and subscribe and share with your friends. Follow any of my other social media if you want as well too. Again, just a normal day trader. So sorry the graphics aren't as great as they probably could be. I'm not a YouTuber, but I wanted to make this video for you guys because I figured it would help a lot of you who were asking questions about level 2. You know, don't forget to join the free Facebook group. We're in there all the time, guys, talking about stocks and travel and things like that. So great source of information for you. There's a lot of files in there to help you as well too with day trading that you can get for free, just to kind of help you build that structure. So definitely take a look at it. If you guys have any other topics you want me to touch on, please, you know, comment below or email me. If you don't want to post in a comment, email me, say, hey Eric, can you touch on this a little bit? And I'll try to clarify it as much as I can, just to kind of give you a little bit more of an edge. And no, I'm not charging for any of this, so don't think that I am. I day trade, I make enough money, I'll be okay. But I'm curious to know, like I said, what you guys' thoughts are on level 2, what you think about it. Do you use level 2? Do you not use level 2? Do you think it's useful? Or what exactly do you use to maybe find big orders? Some people don't even use, you know, level 2. Some people might have some website or a resource that they use. I'm curious to know. So if you want to share that, definitely put that below as well too in the comments. I'd love to talk about it and, you know, find out a little bit more. We can share information and things like that. So you guys stay tuned. I'm going to put out some more information for you that'll probably help you out. And, you know, we'll continue to stay green. All right. Take care.